Hey there, traders, investors, YouTube world. What's up, Ryan Bouchey? How are you, man?
Doing good, doing good. I'm ready now after getting that the intro. I'm ready to go, baby.
It's just boom, right into, just a nice, calm, quiet day working on the business, and then you hear that intro, and it's Thursday, YouTube time, and you just get fired on. My voice, I forgot to mute the YouTube window in my ear. I'm going to go ahead and say I have a pretty annoying voice, Ryan. I'm sorry you have to listen to that all day.
All good here. All good here. What's good there?
Oh, man, what a day. What a day. What a week. I think 7 of the last 9 sessions up. All right. So, we have a lot to talk about, and we have to try to keep it to 30 minutes. So we've got to be out of here by 4:15. We have so much to talk about, so much in this market. Boy, what a difference just over a week makes in the market. We came from record low sentiment, just unbelievably excessive amount of bears in the market to a huge swing all the way back, and not much has changed in terms of the geopolitical front, inflationary front, interest rate front. In fact, rates are still going higher, but yet we have a tech-led rally, so we have a lot to talk about. Ryan, you've been kind of in the trenches in terms of planning and working with customers on the tax side, planning side, allocation side. We did put money to work here for clients who did have cash in the sidelines, who've come into us, since we've launched. We have been putting money to work, and looks like so far that's the good thing. We have a huge chip-led rally. A lot going on the market side, but other than that, what's going on with you? What do you want to start off with?
Let's keep it market related. I do think it's funny when times are tough and scary. Go back to just before, maybe 10 days ago. Is that approximately when maybe the markets bottomed out? And right around the Fed's announcement, right, when they came out and announced their plan with rates and what they were going to be doing. But the news cycle, even on the periphery, it just seems to have shifted a little bit. Not as much talk in terms of the overall impact with what's going on overseas. The markets have certainly calmed down. We're having a great day today. Some of the swings up and down are still, rather large. It's not the year and a half that we had of, incremental gains one after another. It's definitely, we're seeing some larger swings, but as you pointed out, we're seeing a little bit of a growth rally kind of bringing us out of the lows from 10 days ago. And from my perspective, and I'm sure you'll get into a little bit more depth and bring a little bit more clarity, but those are some good signs right now. And coming out of the lows doesn't mean we can't get back to that point. It doesn't mean we're in the clear all of a sudden, but I think probably some of the market activity has been a positive sign of the last, I don't know how many trading days, maybe 7 or 8 trading days, but over the last 10 since mid-March, we're seeing some solid strength right now.
Yeah, that's for sure. I'm just lining up. So I just kind of give you a sector recap here. Let me pop this in. So, let me pop this in. I know a lot of you don't speak in stock and ETF symbols, but so here's the percent change on the day. So XLK, which is your technology ETF, up 2.34% with 10 minutes to go. XLB, which I find very interesting, is materials, up just under 2. XLC is communications, healthcare, I haven't memorized, utilities, financials, discretionary, industrial staples, real estate, and energy. Energy is lagging here, and this is going to be a theme that I'd like to talk about here, sort of in the back half, I would say, of the show. But lagging on the day, which this was a buy everything kind of day. Energy, real estate, staples, industrials, consumer discretionary didn't have a great day. Financials held in there, but led by tech, materials, and communications, which is interesting. I want to look inside the communications sector. I was on CNBC yesterday talking about the second largest weighting in the communications, which is Facebook, Meta. So we'll kind of get into that a little bit. We do hold it in the growth portfolio. It is on watch to be cut. So we'll talk about that a little bit. and I'd like to look into communications. But first, let me bring over the industries. And the way this goes, guys, is you always want to look obviously at the indexes, which would be the S&P, the Dow, the Nasdaq, and the RUT. Then look at the macro, look at gold and crude and rates and bonds. But then I always go down to the sector level, which we just looked at. But then I think to get more clarity as to really what's moving in markets is to look at the industries. And I have an industry scan or kind of sheet set up here, and just to get a little bit more clarity as to what was leading the industries. And this is the Dow Jones Industries. There's probably, I don't know, call it 75-ish in there. What was leading today? I found this really interesting, the semis. Okay, so we have semiconductors, iron and steel, travel and tourism. I mean, this is pretty random so far. Non-ferrous materials, commercial chemicals, airlines, hotels, publishing, internet, gambling, tires, computer hardware, like a little bit of everything. But I love that we've got hotels, we've got gambling, you've got the reopening place, airlines, but you also have materials coming on. And what I really like about this is even though rates are continuing to go up, we have semis leading the way. Nvidia had a massive day after their investor day yesterday. And trust me, I'm not trying to cheerlead and sorry, I'd be like Kramer. I know Kramer. He's always upbeat and always like, pulling out the positives and everything. But I'm very encouraged of a market that can rally in, especially a tech-led growth market that can rally in the face of obviously heavily present inflation and increasing interest rates, which usually takes the shine off of technology. So, Ryan, anything you want to jump in on that one?
No, I think you nailed it on technology and seeing that lead the way and seeing some of those industries kind of up there. I also, and we talked about it last week a little bit too, is seeing the travel, the leisure stocks. And to me, and I think we've talked about this as well, but that's a good sign with the consumer right now. And the fears of a slowdown, the fears of a recession, we're still seeing strength with some of those more consumer-based stocks and industries right now. And I think that's a positive. And I think the one thing that with some of the data points that may be pointing towards an impending recession, right? We've talked about how it doesn't necessarily mean that we have to go towards a recession or we're poised for a recession, but the inflation numbers, kind of the flattening of the yield curve, which we might get a little bit more into later. But at the end of the day, we're seeing over 1 million jobs being created the first 2 months of the year. The jobless claims number that came out this week is the best that it's been the lowest it's been in over 50 years. Wages are still up. All these other factors that are, keep giving us, at the other end of the barbell, like this really, really strong consumer and strength in the economy. And so we're talking about the confusion in the markets and, what to do right now, because again, a couple of weeks ago, it was all negative. And there still are some, negative news items out there and pieces out there. But there's a lot to kind of point to and say, maybe it doesn't have to be that bad. Maybe there's some upside here. And I think when you're looking at what's leading the market today in the last couple, last 2 weeks or so, it's been encouraging so far. It's really been encouraging. It's
been encouraging, and it really has. And again, I just love the sick, twisted nature of the market. And again, the pessimism, not only in everyday investors who have professional responsibilities elsewhere, but within the professionals. The bearishness was amazing. And I'm Ryan and I we're going to talk about this later, but it's our job to be unemotional, and we're going to talk about this later, unemotional when it comes to the markets. We have to kind of hide, like our love for the markets. Like this is the only job I've ever had related directly to trading or investing since I've been out of school. Ryan's always been in finance, more in the planning and tax strategy side. So it's great to approach this job with a lot of passion, enthusiasm. I love sitting down here at 6:30 in the morning or 7 or whatever it is. But when it comes to managing the money, you have to be objective. You have to not get caught up in the market trends and themes and latest meme stocks and crypto stories and NFTs that are going crazy. But I just love watching the sick, twisted nature of the market, pushing everybody into one direction, and then a week later, bam, up 7 out of 9 days, being led by growth, which hardly anybody was talking about. And I'm going to go back and take a little bit of a victory lap. After we rebalance client portfolios in February, I'll kind of show you the moves that we made and the reasons that we did it. And I just want to take 1 sec to go on the side and say, look, the rate of information that we put out, this is the new age of wealth management. This is a very complex, information-packed market. So this is something we've had to clarify, and Ryan knows this, with clients that are coming to board and like, well, I don't want an actively traded portfolio. It's not really what we do. Since we've launched, we've rebalanced twice, kicked some stocks out, brought some in, but we're in. But we're monitoring the markets. We're watching the clues and the signs as if we were an actively trading shop. We're not just sitting here just putting you in ETFs and letting it go. So I think that's kind of what's required. For me, right, that's acting as a fiduciary, which is acting in the very best interest of our clients. We'll get into that. Is there anything you want to hit on that one, or do you want to just keep going and leave that for the back end?
Yeah, let's keep that for the back end, because I have some thoughts on it as well, in talking a little bit about the emotions of the investment process, working with professionals and what we do. But yeah, we can touch upon it.
All right, let's leave it.
When we're seeing the markets kind of bounce back here, right, and everyone was, and rightfully so, concerned and fearful of inflation, and I've seen this sort of sentiment come out the last couple of days, it does make sense, and I'm just curious kind of what your interpretation of it. But in terms of this high inflationary, right, our readings, I think we're in the 7s, the last reading. Who knows what they're going to be for March, because the last reading didn't even take into account the commodities increase from Russia and Ukraine invasion. We haven't even hit that data points in the inflationary numbers quite yet. But in terms of kind of a hedge against inflation, I mean, where else would you be looking to go to? And I know how, obviously the price of stocks, and if we're seeing higher inflation, that's going to impact future cash flows and impact the model of how stocks should be priced. And we got that pullback, and probably rightfully so, right? We were on a pace that we couldn't continue on. But in terms of then taking a step back and saying, well, what's going to keep up with inflation? I mean, equities over time have been the best asset class for that. And I wonder if that's a little bit of kind of what we're seeing right now in terms of, I'm hearing less of the fear from inflation over the last week or two. And maybe that's just because the market's rallying a little bit. Yeah. But it makes sense on the surface in terms of where else would you rather be type, if you had a, from a long-term perspective, where else would you rather be fighting inflation?
100%. And we can clearly see it's not Bitcoin. I mean, gold failed at 2,000. What's the true inflation hedge? And I have a buddy who runs oil trading programs for energy hedge funds, and he said the real hedge fund inflation hedge was crude. Well, we already saw that make the move. I mean, yeah, we're climbing back up towards the highs, but Tom Lee wrote something. Tom Lee, I have a lot of respect for him. I've known him. I've done several industry events with him. He's a technical guy, but he's obviously, he's head of JP. He was head of JP Morgan Equity Strategy. Very, very smart guy. And he said something on CNBC yesterday that really resonated with me. And I tweeted at him. He wrote me back and retweeted it, which was cool. But he was like, look, the rate of inflation is going faster than the elevation of borrowing costs. So if you think about it, if corporates do think that inflation will moderate at some point, or not to the point that the Fed has to raise rates so much to slow the economy down into a hard landing rather than engineering a soft landing, if they're borrowing money at 3%, but the inflation is still running 5%, 6%, 7%, 8%, that spread is how much they're making. You're actually borrowing at a plus 3 or 4% yield. So he's like, you can see companies actually investing and borrowing as you're actually being paid to borrow money, which does create growth, which actually can recreate PE expansion, which the big drop that we saw in the meme stock and more of the pandemic stocks was massive valuations. We saw big price to earnings ratio compression destruction as we rotated into value trades. But maybe the Fed is going to engineer a soft landing, and maybe we're just happy we're getting back to some normal rates of inflation. Interest rates are normalizing. We could go into the yield curve. We hit that one last week, but it's still, if you look at less than a 2-year maturity on the yield curve, it's still normally shaped. It's not inverted. People are cherry picking the middle parts of the curve, 2, 3, 5, 7, and say, oh, we have flattening, we have inversion. But if you look at the 3-month, 10-year, 3-month, 30-year, we're still very normally shaped. So it's just a middle part of the curve, and the Fed would have to raise 7 or 8 times to even begin to get a 3 to 10 month flattening to inversion. And if they're going to raise 7 or 8 times, I think the Fed is much more sensitive to a hard landing with this. Provided inflation stays under, obviously the market's okay with 7, 8, 9%. The Fed's going to back off. They're not going to raise 7 times. I mean, as I said, 2 months ago, everyone was positive the Fed's going to raise 50 basis points in March, and that went right out the window. And now they're doing the same thing in May. We're right back to 50 basis points. That might go right back out the window. So don't tell me for sure the Fed's going to raise 7 times. If the market starts to respond, I think the Fed backs off. But again, I don't know, and nobody knows why tech is leading coming back now. We'll find out in a couple weeks or next week, but nobody knows. And the market is that smart, and you can't sit here and say, I know exactly why this is happening. It'll come out here in a little bit.
Yeah, it's hard to
go ahead.
Gauge that in real time. But I think it was an interesting article today in the Journal just talking about yield curves and how the Fed's really kind of looking at it more, to your point, you've been talking about it the last few weeks. Instead of looking at that the 2 and 10 spread, they're really kind of looking shorter term, right? They're looking at 3-month to the 10-year.
Because that's where the Fed operates. That with the Fed fund rates correlates to the 3-month rate, 13-week, 3-month, 6-month, 1 year. I think they're behind the 2-year. The Fed funds operates on the short end of the curve, and that's where banks are borrowing. Banks are borrowing at 1% at less than a year. It's not a 2-year rate.
Yeah. So I think it's interesting, and you kind of go into, without getting more into it, it's like, okay, what's causation versus correlation? And taking a step back, really kind of this fear of a pullback in a recession really was started with, again, what's going on overseas. And yes, it's impacting us. Yes, oil prices are up. I don't know how long that's going to last. We can talk about commodities briefly after this point, but the bigger factors are some of these European countries, right? I think if you're looking at where the recession is more likely to happen, it's in countries that were very dependent on Russia, the countries like Germany, other countries in Europe. It's going to impact us, but it doesn't have as much. And I think we have to kind of take a step back. And even in the article, they pointed to, even the rates overseas, they're not as bad as the rates in our country in terms of pointing towards a recession. And so it's kind of like a causation versus correlation. And listen, we operate in business cycles. There's always going to be economic and there's always going to be market cycles. And the last piece I'll just leave on that point is, and I don't have the numbers in front of me, this goes back to presentations I did through the years, but the late stage bull markets, right? And we don't know what any pullback is going to be, but the late stage bull markets, typically within those 6 to 12 months of a peak, are some of the sharpest up markets that you can picture. So if you are worried about a recession that again you can't predict, and you can't predict when the markets are going to peak out, if you're trying to get out of the markets and protect yourselves and go to cash, you could be missing out on tremendous upside. And then at that point, do you get back in at the peak, right? It's so hard to time these things. There's so many different factors. You can't just look at one data point.
Right, which is why we weight all of the evidence available to us presently. This is another great discussion that Ryan and I have. Are we in the game, because we're actively managing our portfolio, are we in the game of predicting the future? No. We're in the game of assessing everything that's available to us right now and putting our capital, Ryan and my capital that is in our wealth management business alongside our investor capital, in the best position now. Anyways, let's keep going. You and I get off on tangents and get off show script, but which is great.
Do you want to hit on commodities?
Let me just
kind of on the markets.
Let me do this real quick. So this is the last before we get off the tangent, XLK, which is technology ETF, leading Nvidia, 9.8% Nvidia. Unreal. And there's actually a deal, supposedly Intel and Nvidia are doing a deal. And that's another thing I was going to say, is China's not going to get involved. The Barron's wrote a really good article saying, look, China is not going to be able to supply their own semiconductors. They don't have the capacity. Their biggest chip company, 6 years behind Taiwan Semiconductor, and also cars, automotives. They're not supplying their own. They cannot get involved and face sanctions, and I think it's generally accepted if they do, it's going to be economically disastrous for them. But chips, absolutely leading the way. KLA, 10-core microchip, Teradyne, AMAT, AMD, not a chip here, but Intel, Nvidia, Lam Research chip, Broadcom, just absolutely leading the way. And then I really like the move in materials today. I know Newmont broke out, all these stocks like Nucor, Lin, these guys are looking really, really good. And then let me see how fast Optima wants to be here. I just wanted to see communications. I'll be super, super quick. Let's see if it wants to load. If not, we're going to move on. XLC, I haven't looked at. Oh, Match.com. That's a stock we have held in the past. Meta was actually up 2.8%. Google up 2.3%. Pretty broad-based comms rally there. Interesting. Okay, let me just finish this off real quick, and I'm going to try to do this as quickly as I can. So, love just kind of quantifying value versus growth. And we use this tool, I use this tool called relative rotation, built on the Optima platform. And what it does is it basically shows rotation centered around the XY axis, which in this case is the S&P 500. But what I like to do is benchmark it not against the S&P, but VTI, which is Vanguard Total Stock Market Index. Real quick, what this thing does is it shows you rotation. As you rotate clockwise out to the right, you're seeing relative strength and momentum relative to the benchmark, which is the intersection of XY axis, which is VTI Total Stock Market. So right down here, we have growth. So this is the S&P 500 growth ETF, which is IVW. This is the mid-cap growth, IWP. Up here, that's a terrible teal color. Sorry, I can barely see it. This is mid-cap value, and this is large-cap value. So what you're seeing is basically over the last few weeks, so this is the beginning of the year all the way in, January, February, what we're seeing here is value is actually starting to rotate down. So mid-cap, large-cap value starting to rotate. Large cap growth, mid cap growth is starting to rotate back up. So this started to become clear back here in February as we were starting to see the underperformance of growth starting to come back in. You could even see it out on the monthly. Growth right here has been underperforming. This is a monthly, and then just around October 21, November 21 is when we started really rotating back in. So you're seeing large cap growth. Mid-cap growth is not really there yet, but you're seeing growth start to rotate back in. The signs were very clear. So what I wanted to say there is, if I can find this. So when we rebalanced back in February, guys, if you don't check the New Age site, definitely check it out. I think, down here, Ryan and I put a lot of content out that we think is good. So be sure to sign up. If you go over here to the Insights and Blogs page, you'll be able to sign up for the email. We send you about one email a week. But in this blog on February 10th or 14th, when we did this one, I can show you. If you want to go back and kind of revisit, I think it was a key inflection point in the market. Sorry, Tristan just put this in for us. Ryan, this new page.
Yeah, here you go.
This one right here. So February 14th. So February 14th, if you go down here a little bit, I just want to say the signs were there right here. We're starting to see evidence the outperformance of value to growth maybe starting to lose momentum. So value losing momentum, which precedes a possible turn back in favor of growth stocks. Okay. So we're starting to see evidence of that. And again, the value trade was fully in play, and we had embraced the value trade. We're significantly overweight in energy and financials, and I can show you that right there. But we talked about it right here in the dividend portfolio. This was back in February 8th. Tech, we upped the exposure by 8.5% to 24.14, only to be slightly underweight technology in the S&P. So what that means is the S&P at this time was a 25% weighting in technology. We kicked it up 8.5%, which was in October. Our new tech representation was 22.5%, still 3% under the benchmark. Okay, S&P. But financials, you look at where we are. Look at the green. We're 5.8% overweight in financials. We are 4.4% overweight in energy, which is significant because energy only had a 3.51% weighting in the S&P. So we're up 7% in the growth portfolio. We're even higher than that. So the point here is, I do think there's going to be a time where we've started to rotate back into growth. We've been involved in energy and financials. It's served us well, but I'm telling you, I think it might be time to start looking the other way. And people are just starting to figure that out. So I'm done taking the victory lap. Please pick it up for me. And wait, and I've been doing this long enough in the markets, I'm about to get humbled. I'm fully aware of that.
It always says that to us. Yeah, why don't we're kind of coming up to a half hour, so we'll go a little bit longer than 30 minutes, but why don't we talk a little bit about just kind of the conversations that we've had, between each other, but also with clients. Yep. I keep seeing too, and I've written about this, I wrote about it last week, but this sort of mentality of like investing being easy.
Wait,
right?
hold on. I need to bring you in on this. Okay, I need to bring you on. This was the way the show was supposed to go down, but you and I are terrible sticking at scripts. So I'm going to go back to the page. If you guys haven't read this, don't do it now, but go read Patience Pays. Why Patience Pays right here. Excellent article. Really, really, really good article, and it talks about the behavior that for an end investor who is a doctor, a lawyer, an engineer, whatever, not a market professional, and how not to get caught up in all the numerous themes and trends and the get rich quick and all the media and social media influencers trying to compete for your attention and trying to convince you that they've got the answer and getting rich quick, and it really sparked a good conversation with Ryan and I. So if you haven't read it, please go read it. And that got Ryan and I just talking about the expected behavior between the investor, our clients, and us as the professionals. And we had about an hour and a half discussion that we said, I wish we just recorded it and did it today. So please, I hope that was a good intro. Jump in.
Yeah, I think it is. And we go back, and I talked about a little bit about it in the article, but just this notion right now, and I think even in our industry, there's a lot of advisors that are telling their clients, especially in times of volatility, like, don't worry, the market's going to come back. Just sit in these 3-4 ETFs, which again, for some people that does work, right? Like if you're just going to do that, like it does work, but it doesn't deal with the emotional elements that clients and individuals and people are going through when there's these times of uncertainty and these times of confusion, especially what we've seen over the last couple of weeks, and even maybe a couple of months in terms of some of the market volatility. That doesn't always work. Like there needs to be a little something behind that, and it goes along with, again, this principle and this notion that, hey, investing's easy, right? Like it's just easy. Just hold that one ETF, don't do anything, and it's easy. But you go back and you kind of see what's happened. I mean, we just went through, and we're in it, Russia-Ukraine conflict. We had COVID 2 years ago. I mean, who knew what was going to happen out of there? And you go even the last 10 years before that, when the market was going up, through this bull market coming out of the financial crisis, every year you could point to a very, very, meaningful and rational reason to be hesitant of getting in markets, and rational reasons why the market had to pull back and we had to get some sort of bear market, recession, pullback, whatever it may be. And when you're in those times, like, this is not easy. There's nothing easy about being invested, about trying to take into account all this different information in the news cycle, which is trying to get you to feel bad in one way, either through negative news or
FOMO.
Feel bad watching, or FOMO, right? And seeing people get rich on Bitcoin when it was going, parabolic, or get rich on these meme stocks. And so every which way you're being pulled, and should I put more money in? Should I take money out? And it's hard. It's not easy. And we were just talking about our role in all this, and we love just communicating and being out there to just kind of say how we're interpreting the markets. But in terms of managing clients' money and doing it, on a large scale, being able to take the emotion out of it, because we are just hardwired to be emotional about this stuff. Like there's no way to avoid that. Like this is an emotional element, investing your money. Like it has to be, and you have to have conversations with clients with that emotional element in mind. But from us, in terms of managing the money, taking the emotions out of it is really what we're there for, right? And trying to communicate and trying to make sense of what we're seeing. And I think in terms of what we're doing and how we're managing the accounts, and again, we're active, but we're not day trading, but we're actively watching the markets and rebalancing and positioning clients' accounts. It's a nice blend in terms of taking that long-term approach, but being on top of really kind of what's going out in the markets.
And I think, and thinking of the last point you said, people are hardwired. And like, did you know, like, something I'm trying to remember, I did this when I was an active trader, when I traded for the hedge fund. We are naturally wired to be emotional and rely on, I think I'm going to mess it up, there's the front and back of the brain. Cavemen, okay, when they went into unsuspecting areas, the brain hadn't developed enough yet. Immediately, it's instinct to go back and rely on the back part of the brain. I'm forgetting what it's called, but it's the emotional center. It's where adrenaline comes from, because it's the body's natural defense. As a caveman walks into a cave or behind a tree, they don't know what's behind there, but in order to ensure self-survival or hope, you puff up, you get emotional, you get scared, you get tough. And what's happened then is, when you are aware of that and you can kind of monitor that emotion, you shift the decision making to the front, which I think is called the limbic system, which that's where reason, that's where logic and reason is actually processed in the brain. So if you can be aware of those cavemen tendencies, which when you're trading, you literally are trying to peek around into a cave or look behind the tree. You don't know what's going to happen in the future. So naturally that kicks up. Ryan and I think the real point of the back end of this presentation or webinar is, for me, like I've been trading my entire career. I first started day trading, prop trading in 01, and listened to all the guys who made millions of dollars in the 95 to 98 rally, and then they couldn't trade worth of beans in 01 and 02. Traded through the WorldCom, Enron in 02, 03, traded for the hedge fund in 07, 08, 09, did really, really well in that, and have traded through every smaller bear market. Like, I've been through this, and it doesn't bother me. And I was telling Ryan, like, as we go to managing millions and millions of dollars, I was like, wow, I've been through this before. As a trader, when you up your size, you inevitably fumble and you get nervous, and but as I'm going through this and through our first significant correction in the wealth management business, like, we just stuck to the plan. It didn't really bother us at all. We stayed in sectors in industries and stocks that were showing some relative performance and seems to be coming out of it, but it wasn't emotional for me. But the clear distinction that I think we want to make here is, when it comes to planning on Ryan's on the tax side or the planning side, or me on the portfolio side, we need to be unemotional, and we need to be very planned and operate as a machine. But when it comes to dealing with clients who are very emotionally, and rightfully so, because this is our client's nest egg, this is their entire life's work. And if you think about it, like, I believe our job, and I've read Nick Murray, who's a really good advisor to advisors, write this. If you think about it, our job is more important than a doctor. A doctor's mere job is to keep you alive to the end of your life. Like, our job is to keep our clients' money alive beyond them. So it's inevitably very emotional. So when we deal with clients, and I'm talking to you, if you're a trader or you're an investor, you're dealing your own money, it's okay to be emotional about your own money. And I think that's going to be natural. And I think what Ryan is saying is we have to be unemotional when we're sitting here as a planner or as a portfolio manager. But when we talk to our clients, we very much empathize with them. And it's okay to get emotional. And it's okay to get caught up and feel like you're missing things and hate seeing a 20% drawdown. So I don't know. I really enjoyed the conversation today. I hope that comes through as we're having it for the second time. But you really have to wear two hats, I find, as an IA and an RIA.
Yeah, the dichotomy of it between for us, the two of us, taking the emotions out of the investment process, but then, putting the emotions back there when you are dealing with a client, when you are talking with a client, because this stuff is emotional, and there's nothing wrong with that. And you pointed out, it is hardwired into our brains to be emotional about this stuff, and it was a defense mechanism way back in the past, and it still is today, and to a certain extent. And kind of being able to walk through what's going on, having a plan, working with someone to be confident and be kind of sure as we go through some of these uncertain times. It just gives so much more confidence to your day to day. And I thought it was funny you brought up being important, or maybe even more important than a doctor. And you bring up afterlife. I even think about it in a different way too. Is that unless you're dealing with a health issue, maybe a health scare in the short term, or maybe an ongoing health issue, you're probably thinking about your financial well-being more than your overall health. I mean, I know I think about it with.
That's a good point too.
Whether it's a job, your job security, your family security, what the market's doing, how much gas costs today. You're probably thinking about your financial health more so than even your physical health in a lot of ways. And so, to be able to kind of be there for clients and to kind of guide them through these challenging times, again, without just saying, "Hey, do nothing; it's going to be okay." Like, I think that just kind of takes away a little bit from what's really going on and what we're processing as humans, because it can be scary, and we've talked to a lot of folks that either are nervous, confused, they don't know what to do, and the individuals and folks who we've been doing planning with and have a solid plan in place and are comfortable and they know what's going on. I think it helps kind of get through these, again, the last couple months that we've seen volatility, especially in the last month where things really picked up. So I think that covers a lot of what we were talking about earlier this morning, because it was a great conversation. It was.
The other part, and I know we're bumping up on, we're only 8 minutes over. That's pretty good for us. The other part too is just the whole industry going towards passive investing and just leaving it in, set it and forget it. For me, I don't feel like that's acting as a fiduciary in the best interest of our clients, because you have to know what's going on. You have to know what the trends are and the themes that are driving my colleagues at CBC and what's driving the narrative. You have to understand what's behind them. More times than not, probably 8 or 9 times out of 10, or maybe even more than that, they're not significant, but they seem so significant on a day-to-day basis. And just the fact that I think a lot of advisors, this is why I believe that we're going to be very successful, just put you in a couple ETF portfolios and say, forget it. Say, well, markets can't be timed. You can't predict the future. No, we're not predicting the future. We're not timing the market. We're assessing the now and putting more weight in the sectors and industries and stocks that are showing the better relative strength now, the better earnings expansion, margin expansion, revenue growth, capturing market share. Like, I think, I don't understand how the industry can just put people in a group of ETFs, which you own thousands of stocks. Probably more than half of them are showing earnings contraction, not growing, losing market share. There's a lot of stocks that are not progressing, and the fact that so many people own so many stocks that are not performing, I think is not going by the fiduciary obligation that we have as RIAs. I don't know how you're not actively managing and putting good stocks, and I think the reason is, unfortunately, people just, a lot of them, I think, have unfortunately spent most of their career just gathering assets and not studying the markets. I feel strongly about that. We're going to be talking about this a lot more, and I think we're here to kind of shake up the industry on this one. Not saying there's not other RIAs who are actively managing. I know there certainly are, but the whole idea of passive investing, you can't time the markets and this and that, maybe so. But I think it's in your client's best interest to be plugged in and know what's going on. So when you do consult them on an emotional basis, rather than say, "Oh, forget it, don't worry about it, it'll come back," like that's not helpful.
Yeah, I think there's ways to guide and navigate during times like this, and you want someone that has a pulse on the market, and I think that helps, and that helps just make sense of the world around us right now, and I think we're doing a good job with that. And you brought it up earlier, but definitely go to our website to newagewealth.com, and you can get we send out recording of our show we do on Thursdays, but also you give great market recaps with some charts we're looking at, what it means in the market. We give some planning blogs, things to be thinking about. So if you want to get that, we're usually sending it out once a week. A couple good blogs, this video. Certainly do that. Go to the site and sign up for the newsletter. Yep,
exactly. So guys, leave some feedback down there if you don't mind on that YouTube window. If you're watching now or on the recording, click the thumbs up, and also leave some comments, leave some feedback. What would you like to see in future shows? Do you like more planning, psychology of investing? Do you like more what's going on in the market? Let us know what you'd like to see, and we'll do our best to grow the show such that it serves the greater good. So all right.
Why don't we leave it at that? Great conversation today. I had a lot of fun today.
Yeah, man, that was great. Thanks, bro. And I'll talk to you later. And everyone else, viewers, we'll see you next Thursday or on the New Age website.
Thanks for stopping by. Talk to you.